Good morning, everyone. It's September the 12th. It's a Thursday. And again, where are the weeks going? I just don't know where time goes. All right. Employment data. Employment data was better than expected. Expectations were around 208 to 216 jobless claims. The number came in at 204,000, telling us that the economy is not in a recession, that it's not close to a recession, that it's growing and humming along just fine. The Fed did say they may lower rates just in case in the future if the economy slows down. I don't get that, but here's the thing. Global markets, central bank just announced about an hour ago that they're going to launch a new bond program to stimulate the European economy. That's probably going to push the Fed to do the same thing here later this month. I believe later in September, they're going to be lowering rates, most likely, more likely than not. So that's going to push bonds a little bit higher. Now, not too much higher because the bonds are already anticipating that the Fed will lower rates by about 85, 90%. Now, here's what you need to know. First things first. Let me show you something interesting here. Now, the market has been driven in the last few days by small caps. This is the Russell 2000. It's overnight, it's a little lower. But here's what you need to know. Here, what you're seeing is a higher high, lower high. If I was to draw a line here, you would see a downtrend. But if you look here at the RSI oscillator, it would be an uptrend. This is a lower high. This is a higher high. This is a higher high. This is a lower high. In other words, the market's moving lower here in terms of higher highs. But here on the RSI, the highs are getting higher. So the highs are getting lower on price action, but the price is getting higher on the RSI. That's divergence. Divergence means the trend is going to fizzle out. Also, in addition to divergence, RSI rarely goes to 70, and we're right near 70 level. As you can see here, it's hard to push the RSI up this high, and it's at 70. That's telling me that the odds are that the small caps are going to come down once again. And if the small caps come down once again, guess what will happen to the broad market? Let's look at the broad market. The broad market is almost at old-time highs. Old-time highs are right around the 3,033 level. We're just a little bit away. We're less than a percent away. Very little bit away. But again, we're overbought. RSI is getting a little overbought here. Once it gets close to 65, 70, the RSI is not a sensitive oscillator. So when you see RSI near 70, that means the market's going to cool off a little bit. So let me show you something else. This is the put to call ratio. It was at 80 something yesterday, I think 82. It's now at 78. Now this is a sentiment. It's a contrary indicator. When the market gets really bullish like it is right now, it tends to churn. When the market gets really bearish like right here, it tends to churn. Once we get to 0.78, 0.75, the market tends to churn. So taking that into account with the Russell 2000 seeing divergence, let me show you again. Sorry, I'm a little all over the place today, but I got to do that because the markets are dynamic today, and there's a lot of stuff going on. We have fundamental, we have European central banks, we have employment data, we have the Russell, and we have the broad market. So, again, if you look at the charts of the Russell 2000, which is what's giving the stock market that jolt right now, I'm not liking what I'm seeing right now. That's telling me that the odds are that small caps are going to come back down to the 50-day line, and that's going to drag the overall market with it. That, taken into account with the fact that put-to-call ratio is showing very strong bullish action, it's telling us that the market's very, very close to being stretched out or is about to snap back. Be very, very careful if you're going to go long in these conditions. Be very careful, and if I was going to go long, I would stick to the bond market. I would stick to the TLT, which is a defensive asset, which will actually rally if the stock market goes down. Ticker symbol TLT, you could trade this on with any stockbroker. It curled. It was oversold here, and it curled, and it looks like it's moving higher. And this is a pretty good buy zone right now. So I would be defensive right now. I would be looking at TLT or GLD, which is gold. Let me take a look at gold. I haven't looked at gold in a few days. Yeah, gold is up right now. Yep, right there. Yeah, it's time to be defensive again. So we want to look at utilities. We want to look at XLU, which is utilities, which look like they're coming back up a little bit. We want to look at TLT, which is the long bond. Remember, when stocks go down, bonds go up. When bonds go up, stocks go down. They're inverse correlated. So defensive assets are XLU, utilities, TLT, bonds, and GLD. Folks, don't get too bullish around the current market environment. Put to call ratio is stretching out. It's got maybe a little bit more to go. I'm not liking the Russell 2000. I'm not going to be bullish around here. I'll talk to you guys tomorrow. And be careful around the levels. Don't let the stock market sucker you in around the current levels. Talk soon.